Welcome to this short and crisp webinar. You are going to get crystal clear clarity in this very short duration, and that's my assurance. Before we get into the presentation, let me just take a couple of minutes to introduce myself. I am CA Enrajca, Chartered Accountant by qualification, a teacher, trainer by passion. I started my career in banking industry through State Bank of India, joined as credit analyst, in short period elevated as team leader, credit processing, had opportunity to work on 250 plus projects, it's 5,000 crore plus size. After 4 years of stint in State Bank of India, I moved to CA practice, had my practice for 7.5 years, parallelly took teaching assignments, started teaching financial management, strategic financial management for CA, CMA and CA students. I'm also an empanel trainer with leading private sector bank for training their executives on financial analysis, working capital and project finance. Thanks to technology, today I teach 2 lakh plus students all over the world through my structured online courses, and it's because of the same technology you are also attending this mini webinar now. One more thing, if you don't have your notepad and pen, please pause the screen, go and take notepad and pen because you are going to have lot many key points to make note of in this session. Let's get into the presentation. Let's move on to the second part of profitability ratios, that are overall profitability ratios, or we otherwise call as return on investment ratios. Now in this we have 3 sub ratios. The first one is return on asset, then return on capital employed, return on shareholders equity. Now these ratios are very critical, even critical than the general profitability ratios, because if someone is investing in the business, it's not with an intention only to earn profit on sales, but it is with an intention to earn return for the investment. Because it is possible that your business will make more profit on sales, but it may give less return on investments. So the ultimate focus should be to improve the return on investments, and accordingly the profit on sales should work. So whether the profit on sales is lesser or greater is not an issue, but whether the return on investment is matching the expectation of the investors is an issue. Okay, so that's what we are going to understand from these 3 set of ratios. The first one is return on asset. Let's focus on that. In return on asset, what we do is we will compare the profits with total assets. But now the question is, which profit should be compared? Because we have various profits. Number 1, we have what is known as profit after tax. Number 2, we have profit before interest and tax. And number 3, something little unique, that is profit after tax plus interest adjusted for tax benefit. Actually, the return on investment can be calculated using all the 3 profits. Okay, so it depends upon the context, it depends upon the expectation of the reader of the ratio, that which profit he should use. It can be profit after tax, or it can be profit before interest and tax, or it can be this one. Now, profit after tax will be taken as a base only when the return is calculated from shareholders' point of view. Profit before interest and tax will be taken when the return is looked at from the overall investors' point of view, that is both shareholders and lenders, because lenders will be expecting interest, so we are taking profit before interest. And if you want to calculate exactly what is the return after adjusting for tax benefits and all from the lender's point of view as well, then third method is used, where interest is not simply added back, it is added back after adjusting for its tax benefit. Okay, so let's look at the formula. In the first case, what we'll do, we'll take the profits after tax that will be divided by total assets. But first of all, what is total asset? We'll take current asset, we'll add non-current asset, but what we have to ensure is we are excluding the fictitious assets. So 3 different types of profits are available, but total assets is basically current assets plus non-current assets, and we have to exclude fictitious assets. Now here some numbers we have. Let's see. Sales 100 less operating expenses or 50. Then we have profit before interest, because this operating expense does not include interest, so it is 100 minus 50, 50 less interest. Let's say interest is 10, So profit before taxes is 40. 40, let's say tax is 30%, so 40 into 30% we have 12. So profit after tax is 40 minus 12, that is 28. And let me also give you the total assets. Total assets is 100. Now the first ratio will create a relationship between the profit after tax and total assets. In that case, it will be profit, it will be the return on assets will be profit after tax divided by total assets, in which case it will be 28%. Then we can also have the second formula where we'll take profit before interest. So there the focus will be on profit before interest and total assets. In that case, the formula will be profit before interest by total assets. Return on asset will be profit before interest, PBIT, divided by total assets. So it's going to be 50 divided by 100 into 100, so 50%. And in third case, which is a little unique, where what we do, we take profit after tax, we will add interest, but at the same time we will subtract the tax benefit on interest. Now what is the tax rate? 30%. What is the interest? 10. 10 into 30% is 3. Okay, so when we add back 10, we have to exclude the 30% on 10. So 10 minus 3, what will be adding back is only 7. Let's see the third scenario. In third scenario, what we'll do is we'll take profit after tax of 28. We'll be adding back interest of 10, and the tax rate is 30%. So 30% into 10, so it's 3, that is subtracted. So what we are having as profit is only 35. Now this profit of 35 will be compared with total assets, and this is nothing but the profit after tax but before interest. So 35 on 100, 35 on 100, the calculation leads to 35%. Okay, so this is the first case where we had 3 different types of profit and we have done with that. Then okay, there's a summary where we are capturing all the return on asset percentages. Next, we'll move on to the second set of ratio, that is return on capital employed. The first one is return on asset, where the focus is on comparing the profits with assets, where we have taken the current assets, then non-current assets, we have excluded fictitious asset. Here in return on capital employed, what is going to happen is we are going to compare the operating profit with capital employed. In return on assets, we didn't have that clarity as to which profit should be taken, whereas in return on capital employed, we have a clarity that operating profit should be compared with capital employed. So we need a clarity on what is operating profit. Okay, so operating profit is nothing but profit before interest and taxes, which are adjusted for non-operating items. So it's very clear, operating profit is nothing but profit before interest and taxes, which are adjusted for non-operating items. And what is capital employed? Capital employed is nothing but total funds that are employed in the business, but at the same time we have to deduct fictitious assets, and that's why I told you that it is something related to return on assets. In return on assets, the focus is on total assets. Here the focus is on total liability, which is of course equal to total assets. So in total assets, we have excluded fictitious asset. So in total liability also, we should exclude fictitious assets. So let's have a look at this. There's a balance sheet, liability, shareholder funds are 100, bank loan 100, sundry creditors 100, so the total is 200. Fixed assets are 150, current assets are 150, total is 300. There's an income statement where you can see sales 200, operating expenses 150, so operating profit 200 minus 150 is 50. Then you can see interest of 10, PBT of 40. Okay, so now if you want to find out the return on capital employed, what you got to do is you have to compare the operating profit with the total capital employed. So what is the total capital employed? Now if I add the 3, okay, it is my total capital employed, which is 300. And where is my operating profit? Here I have my operating profit, which is 50. So if I compare these two, that is operating profit with the total capital employed, I get return on capital employed, which is operating profit by capital employed, 50 by 300, so I get 16.67%. So that's how we find return on capital employed. Moving on. The third ratio, very, very critical ratio, return on shareholders funds. Okay, now this is the ratio where we are going to look at the return from shareholders point of view. When I say shareholder, it can be equity shareholder and preference shareholder. I'm not being specific about equity shareholder. I'm saying shareholder. It means this includes both equity and preference. So which profit will be available for these shareholders? That's basically profit after tax. Okay. So in return on shareholders funds, what we do, we compare the profit after tax with shareholders funds. Let's see. What is shareholders funds? When we say shareholders funds, they are basically share capital, reserves and surplus, and preference share capital. But if there are any accumulated losses that got to be deducted, okay, so that makes up the shareholders funds. So what is the formula? Return on shareholders funds is nothing but profit after tax divided by shareholder funds into 100, right? Next, I'm getting into the next level, which is not there in our earlier classification, because when we talked about the return on investment ratios, we had 3 ratios, and the third ratio was return on shareholder fund. I'm going to one leg extra where I'm introducing return on equity shareholders funds. It means here our focus is understanding only the return for equity shareholders. Now, which profit is available for equity shareholders? It is not profit after tax. No. Why? Because from profit after tax, some portion have to be distributed to preference shareholders. So profit after tax less preference dividend will give earnings available for shareholders, and that should be compared with equity shareholders funds, and that talks about return on equity shareholders funds. Let's see. Profit after tax and preference dividend should be compared with equity shareholders funds, and that gives us the ratio. Okay, and the next critical element, the return on equity shareholders funds does not just stop with that ratio, that single ratio, because they are the key owners. So you can't just confine to the analysis with a single ratio. There are actually another 4 to 5 set of ratios, like number 1, earnings per share, 2, cash flow earnings per share, 3, dividend per equity share, 4, dividend payout ratio, and 5, dividend yield ratio, which I'll take you through in the next session.
Thank you so much. We have come to the end of this mini webinar, and I am sure you would have derived much value from this short and crisp webinar. In my opinion, what you have seen is only the tip of the iceberg. There are several other interconnected topics which you have to learn in order to achieve excellence and mastery. So if you wish to continue this learning journey in a more organized and structured way, I have an amazing opportunity for you. I have published a series of comprehensive courses in financial domain, each costing rupees 2000, but I'm going to give it to you at a special offer price today. Here we go, Finance and Accounting Mastery Bundle. In this bundle, I'm going to give you a series of courses. To start with, we have Financial Management, a complete study. In this course, you will be learning financial management in depth. Topics like basics of financial management, time value of money, financial analysis like ratios, cash flows, fund flows, cost of capital, capital structuring, capital budgeting, NPV, IRR, everything discussed in depth in this course. Then we have course number 2. Advanced Financial Management. It's a comprehensive course, and you will learn various advanced concepts like advanced capital budgeting techniques, risk analysis, sensitivity, derivatives, leasing, forex management, portfolio management, dividend decision, mergers, acquisition, several miscellaneous topics, and securitization, security analysis, valuation. Next, we have course number 3. Accounting Basics, a complete study. This course will give you solid foundation in basics of accounting. You will learn basics of accounting, technical terms in accounting, double entry system, journalizing process, final accounts, everything in depth, a comprehensive ever course. Then we have course number 4. Advanced Accounting, a complete study. In this course, various advanced topics in accounting are discussed and covered. Just have a look at the screen for the topics, exhaustive topics that are covered in this course. Then we have course number 5, that is Cost Accounting, a complete study. In this course, you will learn various topics related to cost accounting. You have topics starting from basics of costing till ABC costing. So overall, 5 courses, each course priced 1,999. The overall value is close to 10,000 rupees. It's 500 plus lectures, and what you get is lifetime access to all these pre-recorded courses. You can access them in mobile app and desktop. All this is going to cost you close to 10,000, but today you can enroll for just 2,499. It's not yet over. I'm going to give you something more. You are also going to get access to various bonus resources, basically ebooks. So it is overall value close to 10,000 rupees, 15 ebooks of value close to 1,500. You are going to get lifetime access to all these courses and e-resources.